to tangible on the ground impacts in a granular way. And the asset class that clearly I think has the most traction in the whole tokenization space today is these tokenized yield funds or tokenized money market funds. And the reason that tokenization is so significant in that context is that historically, investors of all types have always faced a trade-off between yield and liquidity. Either you could get full access to, as is generally the case, a U.S. Treasury full yield, or you could have full liquidity in the form of cash, right? But you couldn't have both. If you wanted even to hold a money market fund, traditional money market funds is either next day or end of day redemption, typically limited to banking hours, doesn't work over weekends. And so this ability for the first time, because of tokenization, and as Christine describes, the way tokens can interoperate with each other, you have this exchangeability in a frictionless way between a tokenized yield product and a stablecoin, which can be moved anywhere in the world in near real time at near zero cost, much more efficiently than old world cash does, near real time at near zero cost, much more efficiently than old world cash does. You put the two together and you have a fundamentally disrupting paradigm for the whole system that we use to handle savings and payments.
Alrighty, everybody, what is going on? Welcome back to another CYPRX video breakdown. I hope that you all were paying attention to what Robbie Mitchnick from BlackRock just said to you guys. The old world cash, the system that we currently involve ourselves in, and how stablecoins can handle things so much more efficient and effectively. As always, welcome back to another video. In today's video, we're going to be diving into yield generation strategies, never having to sell your digital assets in this new financial paradigm that we are headed into, that most people are ignoring because they're manipulated by influencers on the internet to believe that the wealth transformation is going to come from selling your digital assets for fiat currency. As all of traditional finance transforms and comes on chain, people are trying to sell out of the Web3 ecosystem to get stuck back into traditional finance. It makes absolutely no sense. This is going to be one of those video breakdowns that you are not going to want to miss. So if you enjoy, do us a favor, smash that thumbs up button and subscribe. I'm going to be kicking it off with some video clips for you guys, and then we're going to get into some fundamental developments, showing you guys some platforms that you guys can, again, go out there and learn about, so that way you can generate yield on your digital assets and never have to sell, and operate like the banks do, operate like the elite 1% of the population do, by utilizing your assets as collateral, lending out your assets, borrowing against them, and remaining liquid in this Web3 ecosystem. So I said here for you guys in this post, which gained a lot of traction, over 21,000 impressions on X, I said the game just got so freaking easy to never have to sell your XRP for fiat. So hear me out. Lend out your XRP on loan protocol and earn 0.76% APY. Then borrow stablecoins against it like USDC or USDT. Step number 3 would be to go and put a portion of those stablecoins onto a platform like BounceBit that earns yield and liquidity pools or vaults to pay the loan back to get your original lent out XRP back. Number 4 would be to cash out the second portion of those stablecoins to your Google Pay, Apple Pay, or Samsung Pay for everyday purchases, and use the cashback feature in XRP from the Gemini card to also pay back your loan. You literally cannot go broke in this new financial system. How do people not see this? So many are ignoring DeFi. So many people will unfortunately get stuck back in fiat. Now is not the time for that. Now is the time to lock in. As we know that Gemini launched this XRP cashback rewards card where you can spend on everyday purchases and receive back XRP. Now, again, this is not financial advice. This is just a strategy that we discuss and talk about in the CYPRX Wealth 28 Club in detail. And so many people think that financial institutions will not participate in these strategies, but they will 110%.
What that unlocks, the sort of instant settlement, the speed, the size of small transactions being financially feasible, just sort of really unlocks a way of transacting globally that really didn't exist before, just the way WhatsApp and tools like that unlocked a way of communicating globally that just really didn't exist before. And I think right now, banks and regulatory bodies are still a little scared of what this technology means for them. But I think over time they'll embrace it and realize they can make money in different ways and use things that they're really good at, like lending, providing liquidity. All of those are important things, regardless if the speed of money goes up and the cost goes down.
Yeah.
Banks over time will do things in this digital asset ecosystem that they're already good at, like lending, borrowing, providing liquidity. Listen to what this gentleman said, because this is going to align with what an individual representative from Franklin Templeton said. Franklin Templeton, aligning themselves with BounceBit, which we'll get into in just a second, says the same exact thing, that these financial institutions will lend, they will borrow, they will provide liquidity, and it will become the new normal. But more so, what I want you guys to really fixate your attention on is this notion that we're headed into an environment where you don't have to leave the Web3 ecosystem. You do not have to sell your digital assets for fiat currency, getting stuck back in the traditional system, and which you work so hard to get out of by accumulating utility digital assets. Take a second and listen to what this gentleman here says to confirm that thesis and that ideology, that now we're headed into an environment where you can stay in the Web3 ecosystem by getting into stable coins, lending out your assets, borrowing against them, and participating in these DeFi strategies, which again, if you are not familiar with, head over to the CYPRX trading website, tap into the Wealth 28 Club, and watch us experiment in the DeFi ecosystem, so that way you can learn, so that way you know how to lend, how to borrow, how to provide liquidity, how to yield farm, how to liquid stake, how to vault. All of these things are important as we transition into this new financial ecosystem. And if you don't know how to do them, you risk falling behind. Take a second and listen to what this gentleman says about not having to get out of crypto.
Yeah, I mean, I think the main thing we've seen is in general, if I take a sort of like historical lens of crypto cycles, you have a sort of ebullient sort of bubble / high growth cycle, followed by sort of generally the sort of bear cycle where people are generally trying to preserve assets rather than kind of invest in new assets. And what you have at each cycle is sort of this kind of money multiplier kind of effect, where like you started imagine you started before one cycle, there's $10 of new capital. At the peak of the bubble, there's maybe sort of $1,000 of levered capital that's in the system. At the end, in the bear cycle, there's maybe around $100. So sort of the crypto general stable capital has grown over time. And if you look at each cycle, what has caused the kind of net retention of capital at each cycle, it's usually some technological innovation. So after the ICO boom, you saw a huge growth in stablecoins, especially in USDT and USDC. And then after DeFi summer, you saw a huge growth in money markets and people actually leaving things in on-chain yield. And I think effectively what we're seeing now is the RWAs are providing a reason for you to not leave the chain. You maybe went on chain, made some money, maybe you traded meme coins, but then now in past cycles, you might have said, okay, I'm going to take my money off and go back to US equities. But now you actually don't have to leave. And I think this notion of this retention effect being much more enabled by each new wave of assets is really important. And to have that keep growing, you need to have composability and you need to have a way of being able to offer yield even through the down cycles. And RWAs act as a sort of counter-cyclic instrument that provides that yield during those times.
So he's specifically talking about, again, not having to leave the digital asset ecosystem by once the market cycles start to shift and things start to pull back, instead of just selling out for fiat, you can put your assets into yield generating strategies. This is monumental. And so many people, if we go back to this post, particularly focusing on two aspects of this post, which is lending out your assets, borrowing against them, and then utilizing those assets in order to get your lent out XRP back, in this case, providing liquidity to generate yield, to use that yield to go and pay back your loan. These are strategies that representatives from the largest organizations in the game are telling you guys are going to become the new normal. Don't take that from me. Take that from Sandy Coal. I've shown you guys this lady's credentials so many times on the CYPRX platform. Sandy Coal, right here, if we go down, she has active participation in organizations like the World Economic Forum, where she sits as a board member of the Digital Asset Advisory Board. She's a current member of the co-chair Digital Asset Subcommittee at the CFTC, and she is a board member of the Digital Asset Advisory Board at the DTCC, and like her credentials are stacked. She's currently the executive vice president and head of innovation at present time at Franklin Templeton. Listen here to what she has to say. Don't take it from me. take it from individuals with credentials telling you guys that this is happening. It's going to be available to everyone, and it will become the new normal. It will be a standard in the future to lend, to borrow, to provide liquidity
in other regions, so that we can have global coverage, right? So a stablecoin can kind of circulate anywhere in the world, but a registered investment product has to work within that jurisdiction. So we've launched a US version of our money market fund, which is a 40 Act. We've launched a UCITS version of our fund out of Luxembourg, which works in many jurisdictions around the world. We have a private version of the fund, and now we just got approved and are finishing up launching a Singaporean BCC structure that works in the Singaporean market. So we're filling out our product set so that any investor anywhere in the world can have access to our money market funds.
Great. Okay. You to use it.
100%. We're super excited about this space. We're just waiting for the regulators to give us a little more clarity on how they want us to treat a registered product in these pools, right? So we're very big believers in liquidity pools. We believe that liquidity pools are going to be a standard part of the future ecosystem. We're very interested in lending protocols and being able to incorporate our Benji product suite into lending protocols as an option other than stablecoins, for that reason that we were talking about before: the higher yield, the more stability around the underlying collateral, the higher transparency and third-party custody that they provide, right? We think that that's going to be a very popular use case. We're working with market makers to begin to be able to make markets against major tokens for our money market fund. So as soon as the regulators kind of give the go-ahead, you'll see us really entering from many different facets of the market, because we really have such conviction that these are the models that are going to really define the future of finance.
Interesting.
You just heard somebody from the CFTC, the DTCC, the World Economic Forum, and Franklin Templeton tell you guys that these are the financial models that are going to define the financial ecosystem moving forward. And what is she talking about? Liquidity providing, lending, borrowing. Do you guys hear these terminologies? This is exactly what I'm talking about in this post. So don't ignore this piece of your education if you are involved in crypto. This ecosystem is not about just hodling anymore. It requires a mindset shift, a strategic shift in how you approach these markets to survive long term. We're going to get into the strategies that the 1% elite utilize towards the end of this video breakdown. But first, since people were asking in the comments of this post, what is BounceBit? So once you get to this portion of the strategy where you've lent out your, let's say, for example, you have an expense, you lend out your XRP to borrow against it to pay for that expense, but you want to pay back that loan by utilizing some of the yield, by putting some of those USDC coins or USDT coins into a liquidity pool. I personally recommend platforms that are regulatory compliant and KYC AML compliant and secure and backed by leading industry experts and organizations in the space that have valid credentials. So I threw BounceBit in the mix. So let's go over what BounceBit is so that nobody's confused that follows me on either X or YouTube that read that post. So BounceBit Prime's first vault uses Benji, Franklin Templeton's FTDA US tokenized money market fund, as base collateral for structured delta neutral yield strategies. Institutions need capital efficiency. Prime uses this execution layer, setting a standard. So I'm just going to read some recent and relevant posts so that way you get a gist and an understanding of what this platform is. We'll take a look at the user interface, and then I'll leave you guys with one more post for today to get the brain juices flowing on how you should go about approaching this Web3 ecosystem between now, 2030, and beyond. So BounceBit has plugged Franklin Templeton's tokenized US T-bill fund Benji into BB Prime, creating a dual yield structure, earning steady T-bill interest while running delta neutral crypto arbitrage. Franklin Templeton shared how their on-chain fund pays intraday yield 24/7 with per second accruals, and how collateral mirroring with OKX and Standard Charter lets assets keep earning even while they're locked. And this is exactly what Franklin Templeton, Sandy Qual, was telling you guys on that little tiny interview that everybody in the world is going to have access to. BounceBit's approach is a first-moving, fast in all regions trading hours. In live test, the strategy produced 22% APY by stacking regulated asset yield on top of crypto returns. So you got all these people in the internet and in crypto saying, oh, double-digit yields are unrealistic and they're not going to happen. Yet here you have an organization and a protocol that is working alongside Franklin Templeton offering 22% APY, which is a huge upgrade to traditional financial APYs and APRs, right? This is massive and monumental information. If we come over here, this is a recent Cointelegraph article from 2025 at the beginning of August, and it just goes on to read a little bit about what BounceBit is. BounceBit, a crypto infrastructure provider that combines features of centralized and decentralized finance, CDeFi, is bringing Franklin Templeton's tokenized money market fund into its structured yield platform, BB Prime, BounceBit Prime, combining U.S. Treasury yields with crypto funds and the basis arbitrage strategies. The tokenized fund, which belongs to the suite of Benji products, will serve as collateral and settlement infrastructure for investment strategies. This way, investors can reap the underlying Treasury yield while adding additional return sources. Coming down here, BounceBit have worked with Franklin Templeton to incorporate operational use of its tokens in active yield strategies, marking what BounceBit's CEO Jack Liu describes as the first real-world application of tokenized treasuries and active yield strategies. Partnering with Wall Street titans like Franklin Templeton signifies that institutional-grade real-world asset products have moved beyond experimentation into scalable, usable infrastructure. You have all these people that are like, oh my gosh, DeFi is not regulated. However, there are regulatory compliant platforms in collaboration with the largest industry experts in the game and financial institutions that are operating in crypto right now, building out these platforms for you guys. BounceBit pioneers CDeFi infrastructure offering institutional grade yield products, restaking use cases, real-world asset integration, and CDeFi as a service, making high yield opportunities accessible to all. It says it right there in their documents. If we come over here and we look at their homepage, here's their homepage, unlocking institutional yield with BounceBit CDeFi. If we scroll down here and just read a couple of highlights, it says, traditionally, high yield opportunities within the Bitcoin asset class, i.e. crypto, were reserved for quant funds and top asset management firms. BounceBit aims to democratize these opportunities, making them accessible to retail investors and smaller institutions through our innovative CDeFi infrastructure. Our infrastructure offers a selection of transparent and secure yield-generating products, enabling users to grow assets within the CDeFi ecosystem. The BounceBit chain ensures transparent and efficient settlement and record-keeping on-chain, reinforcing the reliability of our CDeFi infrastructure. Then if we come down here to read some other highlights for all those skeptics out there, this falls in line with regulatory and security compliances. Comprehensive KYC, and AML protocols ensure regulatory compliance, full transparency, and secure onboarding for all users. They also offer robust asset protection with multi-layer custody architecture, which protects users' assets with secure segregation, strict access controls, and real-time risk monitoring. Then they also offer licensed investment managements operating under a regulated framework, has acquired a BVI investment business license, and enables compliant fund management services across multiple different jurisdictions. Last but not least, with Google Cloud, they offer resilient and compliant infrastructure. They have enterprise-grade cloud security, encryption, and disaster recovery protocols, ensuring platform stability, scalability, and alignment with global standards. This puts to rest all the people that were skeptical about participating in DeFi to now, if you are not starting to learn about how to integrate these platforms into your strategies, you are living in the past. And instead of focusing on the future and how you're going to survive long-term to grow and maintain your wealth, now is the time, I repeat, ladies and gentlemen, to get educated, to be a part of a community like us here in the Wealth 28 Club, where we're really starting to incorporate and talk about and integrate these strategies into our portfolio. So here is what the user interface looks like. This platform is so clean, in my personal opinion. I'm not going to go into detail, but this honestly just looks like some of the DeFi protocols that we talk about in the Wealth 28 Club. You got the connect wallet button up here. You have all of the pools, the strategy pools here where you can generate yield. This is exactly what I'm talking about right now. 12% APR on USDT. You got 7% APR on USDC. So imagine if we come over here to this last post where I'll end today's video breakdown, where I said, XRP holders, listen up. People who keep saying the yield is too small, You are missing the point, because you have a lot of people in this post that were like, oh, why would you go and lend out your XRP on loan protocol just to earn 0.76%? You're missing the point of this technology. It's not about chasing crazy yields. It's about adopting the same wealth strategies that the elites have used for decades, using your assets as collateral instead of selling them. And now, as retail investors, we can do this with a mobile phone and an internet connection as long as you know how to. For example, what do the elites do? What have they done in the past? For stocks and equities, wealthy investors don't sell their Apple, Tesla, or Amazon stock when they need cash. Instead, they use security-backed loans, also called margin loans or portfolio credit lines. They pledge their stock portfolio as collateral and borrow cash at low interest rates. This way, they keep ownership of the stock, they enjoy dividends, and capture long-term growth while still having liquidity. For real estate, high net worth families don't usually sell property to cover expenses. They leverage home equity lines of credit, or HELOCs, or collateralized real estate loans. Their real estate keeps appreciating while they borrow against it to fund new ventures and pay for luxury items or reinvest it elsewhere. Other things like arts and bonds, even art collections, rare wine, or private businesses can be used as collateral for loans through private banks. The principle stays the same. Never sell your appreciating assets, just borrow against them. The big idea here is that the elite strategy has always been: number one, acquire appreciating assets like stocks, property, businesses, and now crypto. Number two, borrow against those assets for liquidity. Number three, let the assets keep compounding in value over time. And number four, use loans, often at low rates, to live, invest, and grow wealth without triggering taxes or losing upside potential. So think about this in my position and my strategy in the post where I mentioned before. You have $20,000 invested in XRP. Let's throw a random number out there. And life throws a curveball at you of a $10,000 expense, and that pops up. Well, the old system, you would be forced to sell your XRP, get stuck back in fiat, and miss out on future upside potential. But this new system allows you to lend out your XRP, borrow against it, get the cash you need, and still keep your XRP working for you. The small yield that you earn is just extra collateral. The real power is staying in Web3, keeping your assets intact and never going broke by being forced to sell. This is how true wealth is built, not by flipping your XRP or your crypto for fiat, but by leveraging assets like the financial elites have always done. This is why the CYPRX Wealth 28 Club is different. So after today's video breakdown and what I've shared with you guys today, keep in mind, none of this is financial advice. All of this, however, does require education and a mindset shift, and that is what I'm asking you guys to commit yourself to. Hopefully you guys enjoyed today's video breakdown. If you want to dabble into how we are utilizing our digital assets in real time to earn passive rewards, passive income, and generate yield, head over to CYPRXtrading.com, go through our DeFi University, lock in with us. We'd love to have you on the team. And if the paid version of CYPRX is not for you and you guys don't want to further your education that way, do me a favor and continue to subscribe and follow the free stuff. Follow the CYPRX YouTube, follow the CYPRX Twitter. We're constantly posting out good, valuable information, non-hopium, non-mainstream, biased, opinionated bullcrap, just facts, good information that will keep you in the loop with what's happening in the Web3 ecosystem. As always, be cognizant, be aware out there, and I'll see you guys in the next video breakdown.